Welcome, everyone. We are pleased that you have joined us for today's webinar titled The IRS's Latest Dirty Dozen List. The webinar will last approximately 20 minutes, and at the end you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you very much, Amber, and I'd like to thank all of you who hung with us as we worked through our technical issues in getting the webinar started this morning. Thank you very much for that. We're glad you're here. We're going to talk today about the IRS's most recent Dirty Dozen list, but as a reminder, next month, our webinar will be about the nuances of death benefit accelerations on life policies. There's some tax and practical nuances there. We'll dig into those next month. Feel welcome to attend. Feel welcome to invite anybody that you think would find the information of value. Our webinars are free and available to those who are interested in kind of learning about the topics that we're presenting every week. They're short too, so there's not a big investment of your day. So before we get started on the IRS's latest Dirty Dozen list, let's go ahead and decide what it is that we're going to talk about in July. The choices are going to be, first of all, the trustee's obligation to irrevocable life insurance trust beneficiaries. The second choice is stranger-owned life insurance gets spicy. And then the third choice would be using UTMA, the Uniform Transfers to Minors Act. I'm going to go ahead and open up the poll and ask you to go ahead and make a selection so we can decide what it is that we'll talk about in July. So let's go ahead and do that. The poll is open, and please go ahead and cast your votes. I'll give you a few minutes. Excuse me, a few more seconds. Give me about 5 more seconds. Anyone who hasn't yet voted will have the opportunity to do it. All right, thank you for voting. And in July, we will discuss the trustee's obligation to irrevocable life insurance trust beneficiaries. Thank you very much for voting on that. So let's go ahead and get into the meat of what it is that we're talking about today, which is the IRS's Dirty Dozen list. Every year, the service publishes a list of the things that they're warning taxpayers to watch out for. And the list isn't always just tax stuff. It's a variety of things, but usually most of the items on the list are tax related. And the 2022 list includes charitable remainder trust idea to eliminate taxable gain. Those of you who do charitable remainder trust planning know that that's a valid use of CRTs, but the thing that the IRS is talking about is abusive. We'll get into that in a second. Second thing is misusing foreign pension tax treaty. In general, foreign pensions are exempt from U.S. taxes, but the IRS has run into circumstances where people falsely claim that they're getting a foreign pension and try to exclude that income from their taxes. We'll talk in more detail about foreign captive insurance and how those are potentially abusive. We'll also talk about monetized installment sales in more detail in a second. Stimulus payments and tax refund scams. There are lots of folks out there who are preying on people using their Social Security numbers in order to get unwarranted stimulus payments or tax refunds. There's also people out there who are manipulating the unemployment insurance system with unemployment fraud, people who are manipulating social media to create fake jobs and cheat people out of opportunities and money. Same with charities, fake charities that instead of money going to charitable purposes, they're just conduits for the promoters to steal people's money. We'll talk a little bit about tax mills with unrealistic promises. We'll talk about tricks aimed to harvest. Actually, we won't talk more about tricks aimed to harvest personal information. You know, this is identity theft. The IRS is warning people to watch out for that. Also watching, the IRS is warning tax professionals to watch out for emails and other information designed to get their clients' information so that people can use that information for nefarious purposes. And then the IRS also puts under its number 12 a bunch of bogus tax avoidance schemes, and we'll talk about one of those in just a minute. So let's go ahead and focus on, first of all, using a charitable remainder trust to eliminate taxable gain. If you're on this call and you've ever promoted or talked about the charitable remainder trust idea to someone, you already know that one of the things that a charitable remainder trust can do is allow somebody with a highly appreciated capital asset to donate the property to a charitable remainder trust and avoid the immediate income tax hit associated with capital gains tax on selling the asset. If the property is donated to a charitable remainder trust properly and the charitable remainder trust sells the property, the trust itself does not pay income tax. That's the good news. And so all that money goes to work for the benefit of the donor to help produce an income stream for the donor. Again, that is the good news. But the bad news is that most of the distributions from the charitable remainder trust are taxable. The IRS has some very specific rules about the order in which distributions come out of the charitable remainder trust for income tax purposes. And in most cases, it's fair to assume that most of the distributions, particularly at the beginning, are going to be fully taxable, either at ordinary income tax rates or at capital gains rates, if a highly appreciated property was donated to the CRT. Well, the promoters of this particular idea are taking the position that little or none of the income that's coming out of the CRT is subject to income tax, and they're doing that unfairly in contravention of the IRS's income ordering rules. And so the service is aware of that. Service is warning unsuspecting people about that. And if you run into a situation where somebody is under the mistaken belief that the income distributions from a CRT are going to be tax-free to them, you can point them to this particular thing on the IRS's Dirty Dozen list to point out that in most cases that's just not so. So that's something that's important for us to be aware of. We do talk about charitable remainder trust planning a fair amount, and so knowing what is right and what is wrong in that realm is an important thing, and advising our clients accordingly is an important thing. Let's talk about abusive captive insurance in foreign jurisdictions. So we've talked about in these webinars, we've talked about captive insurance before, and we've talked about situations where the IRS has successfully challenged captive insurance arrangements that don't have some substance. And we've also talked about one situation where a captive implementation was actually upheld because the taxpayer did it right. But what the IRS is talking about here are captive insurance arrangements that are offshore. Puerto Rico is part of the United States, but other foreign offshore arrangements are part of what the IRS is warning people about. The main point the IRS is making is that these captive insurance arrangements don't have economic substance. They are simply a way for the taxpayer to chase after an income tax deduction. The foreign captive insurance configuration doesn't really ensure anything real for the client's business, and therefore the IRS says it lacks economic substance and should not be honored, and you shouldn't fall for it if you're somebody who has a business and is considering captive insurance. So the IRS, that one has found itself on the IRS's list. Captive insurance arrangements definitely are on the IRS's radar. And so if you've got a client thinking about captive insurance, they should be particularly diligent in deciding what it is that they're going to do, if anything, in that realm. Let's talk about monetized installment sales. The IRS has kind of painted this with a broad brush. And I think for those of us who are trying to help our clients think about the tax results associated with selling an appreciated piece of property, this is important to know. Here at Advanced Underwriting Consultants, we get a lot of questions over the course of a year about things like deferred sales trusts or 1031 exchanges. 1031 exchanges, when they're done right, are a very legitimate way for somebody to defer the income tax associated with the sale of a piece of commercial real estate. You trade one piece of commercial real estate for another using the very specific rules inside of Section 1031. It's a way for the seller to avoid capital gains tax or defer capital gains tax on the sale of the property because the property's been traded for another one in a way that the tax code promotes. For people who also have highly appreciated property, either commercial or other capital property, where they want to avoid the immediate income tax result associated with selling, one of the ideas that has made the rounds over the last many years is the deferred sales trust, where somebody basically puts together an artificial transaction where instead of selling the property for a lump sum, they create a separate entity to be a conduit for filtering through an income stream back to the seller. And arguably, the seller gets installment sale treatment on the payments as opposed to capital gains all at once on a lump sum payment. Well, from my perspective, this monetized installment sales making it onto the IRS's list, to me, makes it clear that the service is going to pay close attention to any situation where somebody is trying to manipulate the tax rules and avoid lump sum capital gains treatment and try to get installment sale tax treatment on the sale of a capital asset. Those things should be looked at particularly dramatically going forward. This is on the IRS's list. They are aware of these types of transactions. And if the IRS is aware of them, the odds service will look at something closely and tell the taxpayer that it doesn't work the taxpayer expects. Well, that possibility is much higher on the list under those circumstances. So let's talk about tax mills with unrealistic promises. This is kind of a pet peeve of mine. Feels like every few years you'll see commercials on television where companies are promising that if somebody owes the IRS a bunch of money, that if you just call these tax mills or other outfits that advertise, they can get the amount that is owed reduced. That's not a simple thing to do. And in a lot of cases, these tax mills overpromise what it is that they can deliver. And so our strong recommendation is that if somebody owes the IRS a fair amount of money, that they talk to their own lawyer about what might be realistic and what they might do in order to approach the IRS, what programs might be available from the IRS, rather than letting a tax mill, an offers and compromise mill, misrepresent what the IRS might do, where you might end up paying the tax mill a fair amount of money without them actually doing anything on the client's behalf to try to reduce taxes. So those kinds of things are on the IRS's radar, but the IRS is warning people not to fall for that trick. And so let's talk about one more thing before we wrap this up. As bogus tax avoidance schemes, one specific thing that the IRS pointed out, which is as timely as anything, is improper reporting of cryptocurrency and digital asset transactions. While the cryptocurrency market has been a bit up and down lately, digital assets bit up and down lately. If someone buys low and sells high, the service is reminding people that that those transactions still can be traced, and somebody's tax exposure associated with participating in the cryptocurrency market, if they make gain, that the IRS can still catch them. The IRS is telling folks, look, don't assume that we won't find out that you've made gains due to your speculation in cryptocurrency assets. We are likely to find out, and if we do, and you don't properly report those transactions as taxable, you're going to potentially be subject to civil fraud penalties and criminal charges as a result of your failure to report. So the IRS is aware of that. The IRS is aggressively going after those folks. So what do we do to wrap this up? Well, first of all, we make the observation that not everything on the IRS's list has anything to do, not everything has something to do with the service or with taxes. They're common sense warnings about things like identity theft and the things that thieves are doing to steal people's money. But for those of us in the life insurance industry and the financial services industry, there are three things I think on this list that we need to pay attention to. The fact that monetized installment sales, of which deferred sales trusts are a subset, they're on the IRS's radar. Abusive charitable remainder trust implementations, they are on the IRS's radar. Situations where the client thinks that the IRS won't find out about their digital asset sales at a gain, that's on the IRS's radar. So those are things that we need to warn our clients about. And of course, the other things that are on the IRS's Dirty Dozen list for 2022, and they'll, in a few months, they'll publish a new one for 2023, which we'll probably talk about again. I'd like to thank you all for joining us for the webinar again. Thank you again for waiting for us as we solved our technical problems in the first few minutes. And at this point, I'll turn the program back over to Amber to close us out. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, June 7th, at this same time. Next month's webinar will be titled Nuances of Death Benefit Accelerations. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again and best wishes for continued success.